Let's move to the next one. Let's go through about the trading game. Okay, so now that we've discussed a little bit on terms of the psychological aspect of trading, what causes your challenges such as fear, hesitation, anxiety. Some of them may be connected to the trading game, so knowing the trading game. There are two elements or always going to be two players. Notice the left-hand side and the right-hand side. Who do you think is on the left-hand side? Or are these traders right here? They are your institutional traders.
Floor traders.
Yep, floor traders, institutional traders. Notice that they don't see any charts, right? What do they see? Only two people or people trading against each other. On the right-hand side, on the other hand, these are your retail traders, like you and I, looking at computer screens and so forth. So when you're trading, we cannot be on the left-hand side unless you're an institutional trader trading for an institution, like Goldman Sachs, for example. And on the right-hand side, we're not on this side. I don't want you to be on this side. And the reason being is because there's a big difference between the two. If you're going to be sitting on the right-hand side and you want to play the game, guess what's happening? This is what's happening. They're buying and selling based on institutional price point. You're selling and you're buying based on what institutions are offering. So if they're buying and you're selling, do you think you're going to win? I'll say that again. If institutions are buying and you are selling, will you win?
No.
Absolutely not. Why? Because these are the people who have all the resources in the world and know exactly what they're doing. This is the reason why they're buying. Hence, if you're a retail trader who has very little resource, little knowledge or experience, and you're going against institutions, then your success rate is probably either 50-50 or lesser than that. If they're selling and you're buying and vice versa, and you're buying, you're also going to lose. So the key is not to be here. You will lose majority of the time. Plus, what's your only form of resource? I'll take this gentleman for example. If that's you, your only form of resource is a chart. What is their form of resource, do you think? See, look, they're not seeing a chart. They're seeing traders.
People, yeah.
They're seeing people. But what do they know that you don't know? That's the question. You don't know what they know. So what are the things that they know? So what are the resources? They know news ahead out of everybody. When I say everybody, these guys, and hence this is why they're getting at a manufacturing price or the cheapest price as much as possible, because they're the ones creating the price, not you, not me. So if you believe that you can beat them, then you're in the wrong business of trading. When I figured it out, and I'm going to the trading floor, I took Bala to the trading floor. You know exactly what it's like on the trading floor, right, Bala? Totally.
Yep.
Right. So here there is a big difference between the two. Don't be on the right side of the game. You will lose. And I don't blame you, because you also don't know what you don't know right at this point in time, because I was also there. I was sitting right there, going to seminars and workshops, learning about trading systems and explaining about systems that are not even sometimes relevant to how things operate. Not until you go to the trading floor and you fully understand the mechanics of how things are, this is where you can have an edge. Other than that, you will never have an edge being a retail trader. So that is a fact, that is not a myth. It's been a couple of years that I've been taking people to the trading floor. Well, Bala was the last one, and a group of people. So the goal for 2019 is to bring members to the trading floor of the S&P and the VIX pit once again. So at least to see, if you haven't been, I highly recommend that you go and see them. Okay? So there's a big difference between the two. Let's define what an institutional trader is. Well, an institutional trader is simply a trader that manages relatively large amounts. When I say relative, it's actually not relative, it's sort of large amounts. They deal in millions of capital compared to most traders. Institutional traders will typically have larger positions and hold them for longer periods of time. When they trade, they often trade large numbers of shares at once or contracts, depending what they're trading, ETFs, options, or futures. Currencies as well. Well, the CME is now closed, not open to the public anymore. We were lucky 3 years ago when the CME was still open actually to see the whole floor from the futures side all the way to the currency side. Actually, it's really, really cool. So it's often said that institutional traders are the ones who really move the markets. They create the large sustained price changes. When it says that it's often said, actually this is a definition through by Investopedia, which is not often said, it is actually said that institutional traders are really the ones who move the market, who moves the markets. They create the large sustained price changes. Most of the noise in the markets come from day traders trying to see what institutions are doing, acting accordingly. The remaining investors do not make a serious impact on the market. Like you and I, we do not make a serious impact. Even if we combine all our monies together, we're too small. What is a retail trader? Well, a retail trader, on the other hand, are individual investors who buy and sell securities for their personal account and not for another company or organization. We are all retail traders. That's the difference. However, what defines you and I, on the other hand, is that I call myself as a professional observer. Likewise, when I educate members, I educate them to be an observer. What is an observer? Well, an observer is a type of retail trader who observes the movement of institutions to look for clues that institutions leave behind to trade and be with institutions. That is the difference. So this is a photo that I took a couple of years ago when we went a few years back. So this is CBOE, this is the VIX pit. That's why if you're trading futures like the S&P, for example, the VIX is connected to the S&P. The S&P is on the outer side. Actually, next door is the S&P pit. So as you can see here, outsides are your traders. The insides are your market makers. The market maker will create the market. They are your manufacturers, and the manufacturers have the advantage because they can hedge their positions, they can buy and sell at the same time. And then once they create that price, people will be looking at it and say, all of a sudden they're waiting. One person buys. So this is what happens. When there's no news, they're waiting for the news. Nothing. When everything that you see fit on a candle, or if you're using candlestick charts or open, high, low, close, bar charts, if there's no movement, it simply means that these are retailers trading. Sometimes hedge fund managers or the little people, basically. These guys are not trading. They're not looking at it at all. But once they know that news is about to happen, even before the news will happen, someone will start manipulating the marketplace by buying bits and pieces. Then it will go up and down, but they're leaving clues already for everybody anyway. And then all of a sudden it will spike. When the only time it will spike is simply if someone bought a large amount and people would go in, and that's where the volatility hits. based on liquidity. These guys, if everything basically is all gone based on the best price, some of them will swear, will curse, and will get pissed off because they're too late. Remember that time, Bala, when the guy threw his lunch?
Mm-hmm.
Right? So that's what happens, because the guy was having lunch, he wasn't focused, then all of a sudden, bam, he missed the whole price because it's all gone. And this is actually the time when the VIX exploded to the upside. That was October 16 or 19. Normally around October, there's a week where the S&P will actually drop. So this was so volatile during the day. It was beautiful to watch. So I love trading as well. We look at news. News is a very important element before news, and then we can identifying where institutions are buying and selling are actually very, very important. So they will always leave clues whether we like it or not. At the same time, here, if we cannot be part of the game, then you might be wondering, then where are you supposed to be? If you're not allowed not to be here, then this is where we are at. We are outside, like watching a basketball game between Golden State Warriors versus LA Lakers, for example. We cannot be in the NBA unless you choose to be an NBA player and you are a professional NBA player. Other than that, you're going to be sitting on the sidelines like everybody else, watching, enjoying the show. And if you want to place a bet between the two, then you need to know statistically in regards to the data that you have in order for you to place the bet. You're going to place a bet to Golden State Warriors, or you're going to place a bet with LA Lakers. If you know the odds based on the statistics that you have, then you will place a bet with Golden State Warriors because that's the highest paying odd. Likewise, in trading, here's now a big problem. The problem is this. People don't see it that way, especially retail traders. Notice, no offense, there are the majority of the retail traders are more mature adults. And they're learning about something that is not even close to what they should be. You want to make money, and this is where I finally realized, because as a retail trader, at the very beginning, why am I buying at retail price point? Can I buy it also at manufacturing? Not manufacturing, you can never get a manufacturing price. Can I get it to where, as close as possible to where institutions are trading to get the lowest risk in order to have the high probability of winning? So if you think that way as a business person, then you'll have an edge making money in the marketplace. Now, once again, you may even have a good system, but psychologically, if your psychology is below par because you have a lot of beliefs, especially limiting beliefs, a lot of fear, you may even have a very good system, but if you can't execute because you're afraid, then there's no point trading either. That's why there has to be a balance between your technical game, your mental game, and there is a connectedness between the mind, body through physical. It's this triangle is an important element. These guys, guess what? These guys, they don't think. They have no room for thinking. They react to every single movement of what the market basically does because they're there physically in the marketplace. Us, on the other hand, we have time to think. When you have time to think is where issues, problems, and challenges arises because we think. If you're an overly thinker, analysis paralysis, you'll make a lot of mistakes. That I can guarantee you. Okay, so just be aware, be careful. So that being said, if you want to make more money or be more consistent, that's a better word. If you want to be more consistent, stay away being part of the game, be an observer, observe what institutions are doing. So the question now is, what are the key things in order for you to observe? Well, I'll give you some examples. to observe the markets is through the macro fundamentals. Macro fundamentals plays a very big role analyzing the markets. In my opinion, it's at least 33%. So this is simply the indices, like your S&P 500. We look at the S&P, we look at the futures price sometimes at nighttime. So automatically, it's very easy. Once we know that, the odds and probability, if we choose to trade on the futures, if I choose to trade the futures, it becomes easier because we looked at the overall global economical conditions when we're trading. And then we look at the VIX. Is there some form of divergence between the VIX and the S&P? Is there going to be some form of divergence between the S&P and the Dow? They should be in the same effect, that if the S&P is up, then the Dow should also be up. If the S&P is down, then the Dow should also be down. In this particular case, Dow is down 120 points, almost 0.5%. S&P is down 0.2%, down 6.7 points. So by forecasting this, what are the odds? We need to define forecasting too, by the way. So let me continue here for a second. Be part of the tip, please do not become a retail trader. You will lose 9% of the time. Be an observer and always know the players of the game. That's not it. Why do you're going to be objective? You're an observer. You're going to be more objective in reading the markets and what the markets dictate with no perception and emotion. There's no distortion. When you have perception, then there's some form of distortion when you're trading because of energy vibration that's inside of you based on your emotional component, especially if it's on a negative emotion state. Bingo, then you're gonna be more in trouble. And the reason being why I say that is because if you're in a negative state and your energy vibration is on a negative side, that will affect the way how you're going to trade. Hence, the subjectivity of it. Subjectivity lies a lot because of the unknown future. When the future is unknown, it's very easy to have fear. On the other hand, fear is also good for you because it can also affect your energy vibration and it will tap in your third physiological beingness, which is your intuition. Hence the terminology human being. You have 5 physiology and there's a 6th physiology, which is now your intuitiveness. The other 5 are simply your auditory, your hearing, your visual based, your kinesthetic based on feeling, gustatory, and non-sensory based. Okay, so words such as I think, I don't know, I try, all these things are non-sensory based. Gustatory is simply what you eat, the taste, right, and the feeling, kinesthetic. And then you have your 6th physiological sense, which is now your intuitive sense. Hence the terminology human being, the being part. Human is part of your senses. Being is now the other one that nobody can explain. It's a mystery. It's a mysterious thing. It's just purely based on energy, and you just know when you know. You know, when you're trading, I bet you're 100% that sometimes you know exactly that if it's such a good trade, it's simply you just explain it. You're just going to go along with it. You're going to buy it or you're going to sell it. When that happens, you just know this is when you maximize your risk. But when you're unsure, you're uncertain, then you have to go back to your technical analysis background or your knowledge to read what the markets are telling you. But you have to back it up though. See, if you have nothing to back it on to, and if your trading system and you're only backing up on an indicators, forget it. Indicators have its own purpose. You need to know the purpose of the indicators that you're using. It is just an added tool. Remember that indicators are all lagging indicators based on mathematical formula. And if they are all lagging, they are just an extra added tool that will give you on top of your forecasting based on your statistics. That creates the probability. No more, no less. If your trading system is using indicators to buy or sell, I'm sorry to say, then you don't know anything about trading. I'm being blunt about it, and it's just the way it is. What it is simply you need to know how to read price. And what is price? Price is being affected by certain factors. What are those factors? Well, those factors are based on news. Everything is news-based, whether you like it or not. That news will affect the price for institutions to buy or sell. And if there are more buyers and everybody will follow based on law of supply and demand, what happens to price? Come on, guys. You guys are traders here. Remember, this workshop is not about me. It's about you. Based on law of supply and demand, if there's more buyers than sellers, what happens to price?
The price goes how high?
Great. Who agrees with Bala that the price will go up? Jen, Andre, Mandeep, Scott, Tyson. Is everybody still there? Hello?
Yep.
Awesome. Great. Thank you, Andre. Yes, the price definitely goes up. So I do agree as well with Bala. So on the other hand, that if there's more sellers than buyers, then definitely the price will drop. So price is going to be connected with news. And if news will affect price, that creates supply and demand, then it will also create trends. Trends are based on harmonic vibration. It's almost like institutions already know what's going to happen, and there is a lot of different factors in order to create trends. Okay, so moving forward from there. So it's important to know exactly as well in regards to objectivity of definitions, such as technical analysis. Remember that technical analysis is the study of price movement or price action to forecast future price movement or price action using present and past price movement or price action. That is purely what technical analysis is. Forecasting. So what is forecasting? Well, let's define forecasting as well. That if technical analysis is about forecasting future price movement, then what is forecasting? Well, forecasting is simply defined as gathering statistical data using present and past data and other pieces of information to create a probability of winning on where price is going to go, either going up, down, or sideways. So in other words, if we are looking at a chart and that we are forecasting future price, and let's look at the S&P right at this point in time. So there's one beauty about teaching in a live trading environment. Teaching actually is challenging because you also have to explain things and you need to prove the theory actually works in real time. Anybody can teach, anybody can do, anybody can show you can make money when the market is closed. Everything is easy when everything is closed. Everything is always good in hindsight. And it will tell you, well, you know what, I bought it over there and then I sold it over there and I made money. Yep, everything's great. But how can you explain then the system or the theory in real time that it really works? It's challenging. So, and the reason being is because you have this future that is unknown. Therefore, if trading is simply defined, or technical analysis is defined as forecasting future price movement. And what is forecasting? Is gathering data in the present and in the past to create a probability. Based on that data, that will create a statistical data. If you have that data and create a statistical data to create the probability, then what is the probability that the price will go up? What is the probability that the price will remain the same? Or it will go sideways, like something like this, go up, go down, and go sideways. Currently, it's going sideways. 2 days in a row, it dropped, and then it went up, down, sideways. Now, what is the probability? It will continue to go up. What is the probability it will go to the side? What is the probability it will go down? So you only have 3 different directions, no more, no less. Then the probability is already 1/3. If it's 1/3, even before you even buy, then you have a 33% success rate. Next, if you eliminate 2 of them, either you're going to buy or you're going to sell or you hold. Well, hold, you're not going to put any positions, then you won't make any money. But if either you're just going to buy or sell, then that increases now to how many percent? 50%. Because you're buying or selling. Then that means that from a starting point, whether even before you decide, you have a 66% deficit in order for you to create a 100% probability of winning. The question is, what is this 66%? Well, the 66% that you have to gather are the pieces of information that you need to find out. In my own opinion, these are basically the macro fundamentals, the macros, news, geopolitical news, any type of news that will affect the trade that you'll be trading. In this particular case, if you're trading the S&P, what are the news that you need to figure out, that you need to find? Well, easy. You have FOMC meeting that's going to happen basically next week. Any high impact news. So use Forex Factory. There's a lot of free websites that you can actually use in order to find free news. Like today we have in Europe the ECB and main refinancing rate based in Europe. So from a medium impact news to high impact news, that's what caused the dollar to basically go up. That's what caused the S&P to basically drop. They all are all connected. So if you have all these things, then you are you can find more of the connectivity. It becomes way easier. It doesn't matter if you're trading futures, you're trading stocks. Well, to be honest with you, stocks is the hardest because it's on the bottom end of the pool. Then you have currencies, then futures. Basically, you have the futures index, like the ES or the YMs. But if you're trading ETFs or you're trading stocks, right? So it doesn't really matter. They're all connected. So when the S&P tomorrow, like if we're going to forecast this, notice that there's uncertainty. Uncertainty means it's not moving. The price went up, came back down. It didn't really move that much. I mean, 0.34. That's a normal day. Basically, you want volatility, something like the day before. Currently, there's been a lot of volatility since actually December, right? So they're waiting for something. And they're waiting for something. What would it be? Well, you don't have any U.S. news tomorrow. There is a WEF annual meetings, which is a medium impact. It could affect the S&P, it could affect the Dow, it could affect every single basically marketplace out there. Oh yeah, by the way, chart is a chart. People always say, "Oh, I don't know. I can't read the chart because it's not the stock. It's not the stock market." Or I can't read the chart because it's not the futures market. You know what? If you don't know how to read price, you don't know how to read the chart, it doesn't matter what you'll be trading, then you just definitely don't know. And the reason being why I say that, because if you know how to read a chart, it doesn't matter what you're trading. From a futures perspective, all the way to a currency, to an ETF, a chart is a chart. You only have price and you have time and have distance. Those are only the three components based on technical analysis anyway. No more, no less. So if you know how to read price, you know how to read a chart, doesn't matter what you trade, you can make money, right? That's why I heard that a lot, and there's a lot of limiting beliefs out there that you only need to learn how to read a chart based on what you're trading. No. In my opinion, once again, I'm going to be blunt, no offense to everybody, no disrespect. The person just doesn't know anything about trading or technical analysis, period. Okay, so that means that person needs more training, more learning. That being said, moving forward, next week, you have CV Consumer Confidence on Tuesday, nothing on Monday. Tuesday, Wednesday, this is where it's going to be volatile. You want to be a day trader, then trade where you have high impact news. At the same time, if you're day trading and you're trading S&P, you're trading stocks, be aware of high impact news. If you're not trading and you're not looking at news, you're in trouble, because this is also the same time people get snapped out really quickly, not realizing that news is about to happen. Then next thing you know, I'm going to put my stop loss at this price point because I want to get a 2-to-1 reward to risk ratio, and they're not dealing it based on the probability. And hence they get snapped out, put in another trade, they get snapped out again, put another trade, they get snapped out again. And one of the major issues is that they're not aware of those news. That's what's affecting them. Wednesday is an important element. Notice that there's no change, 2.5%. So FOMC statement, federal funds rate. Thursday, nothing. But Friday, we have non-farm payroll. So next week will be a very busy week in terms of trading, and this is awesome. When there's volatility, that's where you want to trade. No volatility, don't trade. Actually, that's why option traders and day traders do not like it when there's no volatility. Meaning that if the VIX is something like this and it's not moving, this is where option traders don't really make much. They make a lot of money when there's a lot of movement, a lot of volatility. Likewise in trading. All right, so that being said, I believe there's going to be some more of the S&P dropping sometime next week. So on the other hand, though, I'm bullish for a very short term. It all depends on next week. If it creates a lower high, this is going to fail to the downside. Other than that, we have a higher low. Part of that higher low, you might be wondering, how can I read that? Where is that higher low? Where? Well, there's two things that I look at. Highs and lows, by the way, are very important when it comes to trading. And the reason being they're important is because institutions are the ones who can buy at the lowest price, who can sell at the highest price. But there is a buyer, there's a seller. There's a seller, there is also a buyer. So there's two ways. Either the markets are hedging themselves, or they're manipulating the price, thinking that baiting retailers to bait, or institutions will be baiting their price, but in reality, it will go the opposite way and just take everybody out. That's what they do, and that's their job, right? So us as retail traders, on the other hand, we don't have that ability because we're not on the trading floor. So hence, the highs and the lows and closing price points are important. Two indicators that I use, the 8 and the 10, is a part of methodology. Moving averages will always going to be the last because they're actually, it's a trending indicator. So as trending indicators, you're already getting a retail price point. However, can you still make money based on retail price point? Absolutely, provided the probability is there. If the probability is high, then by all means you can buy it at a retail price point. Can you also get it at a wholesale price point when the retail is at retail? Yes. Retail becomes wholesale is when the price comes back to a level of demand. We have certain rules. We only buy at demand. We never buy at supply. We never sell at demand. We sell at supply. So those two rules play a big effect as part of the trading methodology, right? Whether it'll be method 1, method 2, or method 3. All right, so from here, price is at a level of demand, creating a higher low, and hence the odds and probability for it to head back up to 2675 is highly probable. When I say highly probable, I can measure it between 80 to 95%, almost 100%. And the reason is because your higher lows has hierarchy. On the other hand, since October, it's been also in a downtrend. But overall, if you're dealing here on the monthly time frame, the month of January is creating now a proper higher low. Everything you see fit here is just a correction from the last impulsion that it created. When there's an impulse, it will create a correction before another continuation of the impulse will happen. So that being said, from a higher low, the only two things that it will happen: create a new higher high or a new lower high. If it creates a lower high, and that's what I'm waiting on, once a lower high, then we now have a change of market direction, that we're going to be in a bear market as a bigger correction of the impulse that happened in 2009. Other than that, long term, we are still bullish. You cannot ignore that the trend is up. These little parts over here are simply your correctional component, and hence, based on short term, you're bearish. We are bearish short term. Long term, you are bullish. So when price heads to demand, you have no choice, but you have to go long. You cannot sell. Institutions already know ahead out of time, out of their plan, what they want to do. So that being said, the S&P has a probability that if it finishes like this, then a continuation of price to the upside, medium to longer term, will happen. Shorter term, same thing, a continuation of the price to the upside, where it will also oscillate itself, where it will also head back down to the downside as a form of a correction before a continuation of price. And then you can continue that in regards to with the volatility index to see whether if the price is also in the same effect. Well, notice you have a series of higher lows. So from a higher low, then you also have a lower high it's currently forming today. So which one switch? Well, the odds and probability that this may continue to go up slightly or some form of another uncertainty will occur because there's no news. So when you have stability, form of a correction as a form of stability, then another stability will occur unless a continuation of the price of what happened the day before will happen. So that being said, if this one will go bullish tomorrow, then the S&P will continue to drop even further tomorrow, maybe back to the level of demand right here in preparation for Wednesday to Friday next week. So mark my words, that's 10:54. Check it out and see whether if we are our forecast was a spot on, but if not, then why? Well, and this is where that we have to go through what is it that we missed. Well, we looked at the news. There's not much news from now till Wednesday, and then Friday will be the other major news. So the Dow should be on the same boat. So it's the same boat. Long term is also bullish. It should be bullish, created now a new higher low. So the odds and probability to come back all the way to 27,000 is highly probable long term for the next 6 months to 9 months. If not, if they're going to keep increasing interest rates and they're saying 2 more times this year, then this is going to create a lower high somewhere sometime, and this is also going to fail. similar with the S&P. Weekly, potential continuation of price next week. Likewise for the daily time frame, from a higher low for a new higher high, heading towards 25,000. That's at least 600 points to the upside. Okay. Then the major central hub is simply the dollar index. What is the dollar index? Well, the dollar index is a futures indicator that got created in 1973 when they took the gold standards out. They put in the US dollar has to be based against 5 major currencies across the globe, and that's your Japanese yen, the Canadian dollar, the pound, the Swiss franc, and Swedish krona. So why is Swedish krona there? I don't know. I think maybe because of some of the imports of what they do via Volvo, IKEA. So, but nevertheless, the Swedish krona is basically there, and so it tracks down the valuation of the US dollar that got basically created in 1973, which started from parity, which is 100 basis points. What does this mean? It means then that if the dollar is valued at 96 cents per dollar, and in 2002, $1 is worth $1.20. So this is based on the purchasing power of parity. This is based on inflation. The value of $1 in 2002 is worth more than the valuation of today. So if, say for argument's sake, you had $1 million, and out of $1 million, you put it to a normal bank, your value in 2002 is worth $1.2 million in 2002. In 2019, your $1 million is worth $966,100. So if you're basing it on parity, 2002, you had an additional valuation worth of 200,000. Right now, you have a devaluation of the price of 40 grand. Is that still pretty good? Absolutely. However, in 2008, your $1 million is worth $725,000, where you've lost $275,000 in valuation based on the purchasing power of parity. That means that if you went to Europe in 2008, you will be perhaps staying in a 2-star hotel, eating hamburgers or fish and chips because it's too expensive. In 2002, on the other hand, if you went to Europe, you can stay in a 5-star hotel, you can eat steaks, lobsters, caviar because it's cheaper, meaning you have more value of your dollar. Right now, your value of your dollar is not too bad because it's almost 1-to-1. So here is the value currently, the euro US dollar, right? Let me click in the euro dollar. See here, euro was worth 1.6 US dollars for 1 euro dollar. That's expensive. Look, in 2002, $1 US dollar was almost 1-to-1 with the euro. So one euro is equivalent to $1 US and 19 cents compared to $1.60 US dollars. Right now, 1 euro is equivalent to $1.13. So compared to $1.19 over there. Oh, sorry. Hang on a second. 86 cents. What am I talking about? Sorry. These are simply the lines on that side. Beg your pardon. So here, 2002, 2001, it is 85 cents. 1 euro is equivalent to 85 cents US. That's why you can stay in a 5-star hotel, eat caviar and so forth, because it's cheap. But if you went to Europe in 2008, 2009, forget it. Why? Because 1 euro is equivalent to 1.60 cents, 1.6 US dollars. So it's too expensive. Right now, it's also good to go to Europe because it's almost parity, almost 1-to-1. 1 euro is 1.13 cents US dollar. Does that make sense? Okay, so that's based on purchasing power parity. You have more value of your dollar in 2002 compared to 2008, 2009. Right now, it is around parity. That's why the dollar index plays a very big role. So what does it mean? Well, it means a lot because the global markets, if the global markets are connected, let's talk about business here for 1 second. Let's talk about retail business in terms of clothing. If you want to make money, where do you want to buy your clothes? You want to buy it here in the US, made in the US, where labor will be more expensive? Or will you buy your clothes in Asia, Haiti, Mexico, where labor will be a bit more cheaper?
Yeah, at a cheaper price, at a cheaper place.
Absolutely. So you want to buy it at the cheaper price so you can have more volume to sell your product either online or at a store on a retail. Now make it this way. If the dollar becomes too expensive or you have a more valuation in terms of the dollar more being expensive, the currency, let's say for example, not the yuan, because the Chinese yuan is standardized. Let's say the Mexican peso, for example, the dollar goes up, the Mexican peso basically drops, better for the economy, simply for a US retail base, because you have more volume that you can basically purchase. On the other hand, if the currency of others, on the other hand, are less valuation, you might have enough products in there. Now, if say, for example, you own Macy's, or you own Amazon, or you own Lululemon, there you go, even better, Lululemon. It's good for the owner because if they buy it overseas wise, then they can have a bigger volume. However, if we're talking about consumer price, if you have tourists and the dollar is too expensive and their valuation is too low, do you believe that tourists will come to the US and visit the US and spend money?
Too expensive.
No, exactly, because it's too expensive. So if the country is based, one of the economies or the economy of that country is based on tourism and there's no tourists, then everything will be affected. Businesses will be affected. And if business will be affected, there's no tourists, no one's going to buy. then employment rate what will happen to employment rate will basically decrease. Unemployment rate will increase. So loss of jobs, and there's loss of jobs, and people won't be able to buy. So it's a spiral effect. At the same time, people overseas won't be able to invest as well here in the US because it's too expensive. They're not going to buy stocks. They're not going to buy ETFs. They're not going to invest in anything because of the valuation of the dollar is too expensive. Then what would be the case? If the dollar is going to be too expensive, what happens to the S&P, which is now a basket of stocks based on the top 500 companies in the whole US? This will be a good one for Mandeep, Steve, Jen, Taisto, if you, Jen and Taisto, you guys are still there, and Scott. What happens to the markets, mainly the S&P?
Markets will be low. S&P will be low.
Okay, great. Thank you, Bala. Do you guys understand with that one? Scott, Andre? Jen? Okay, great. Thank you. Thanks for the feedback right there. So the market basically will drop. The S&P will drop. The Dow will drop. And notice here there is a beautiful correlation. So the S&P is currently down. In actual fact, they just pushed the price back up a little bit right there. Let's see. 1 hour, 11 o'clock. Bam, yeah, all right. So it's currently coming back a little bit. Currently down just 0.8. Dow is still down 0.3. But the dollar index is currently up. Right, so that's a relationship between the dollar index and the indices because of its connectivity. Everything is all connected. So at the same time, the dollar is also connected with oil based on the petrodollar, as long as the dollar, the US dollar, will still be the major currency in terms of point of trade, where other countries will exchange their currencies to the US dollar. So if the US dollar is too expensive, what happens now to the demand and supply of oil? Well, if it's too expensive, then others won't be able to buy. Then when there's no demand, rather, there's no more supply, then oil should drop, and vice versa. Here, on the other hand, there is divergence between the dollar index and US oil and crude oil. So Texas oil, why is oil up? Well, why is the Dow up? The dollar index is up. The dollar index is up, likewise for oil. Then one of them has to follow suit. One of them is leading, one of them is lagging. So here, on the other hand, there's a probability that oil will keep on going. And that means then that somewhere, sometime, the dollar should also head back down. So if oil is also going up, then the dollar CAD should also be dropping. Let's see. Neutral. Okay. So UK oil is neutral. Odds and probably may continue to go further up on this one as well as highly probable, where now the dollar index with potential also drop somewhere sometime in the future. If the dollar index will drop somewhere sometime in the future, then the S&P will also continue to go further up to the upside. All right, so same thing with gold. Gold is currently in clear relationship with the dollar index. It's down when the dollar index is up. There's more room for this to head back to the downside, in my own opinion. Currently in the level of demand, on the other hand. So unless there's a clear breakout from a level of demand, this will head back all the way down, back to $1,200 an ounce. Copper is the same. Currently still down, or the dollar index is also up. Could potentially head back further to 2.5 right there, an ounce. So until a clear cut of a higher low will happen. Other than that, I'm also bearish with copper. Likewise for the yield. So the yield, I find that the yield is always leading. So the 30-year treasury yield is connected to the bond market and is also connected to the dollar index. Hence, notice there's a gap. So in my own opinion, dollar index, sometime, this is also going to fail to the downside. All right, so that is the macro fundamentals in terms of its connectivity within each other. So in my own honest opinion, there is, when it comes to forecasting, you need to find proof, you need to find facts. What are the facts that you can back your trade? You either buy or sell. Okay, any questions? Scott, any questions? Andre, do you have any questions? Nothing?
Yep, no questions.
Yep, all good.
Oh, good. So if there's no questions, everything's all good. Let's have a quick 5-minute break. Now it's been 2 hours. Can't believe time flies. And then when we come back, let's continue and see what other challenges you may have technically. So mentally, we've done that. Let's go through about the technical aspect as well. All right, 5-minute break, guys. 5-minute break.